So the other day, I revealed my dividend stock portfolio and I got a lot of feedback, a lot of comments, and I want to kind of address how I'm doing it and why I'm doing things probably different to what you would. As I said before though, I am 34 and I'm looking to do this within a 16-year time frame to hit a very lofty target. And the plan is dividend growth investing. But the thing that you don't know is, or you may do, you might see in the background, I'm a cryptocurrency investor. I invested in cryptocurrency in 2016. Before that, I was in the stock market. So there has been a lot of comments about you should be doing growth. That was my growth. I invested in Bitcoin when it was $700. And it has given me full-time life of being able to quit the military and do this since 2018. And now you're starting to see a different side of me in terms of diversification. But as I say, that is my high risk, that is my growth, so it's not going to be on here. But overall, this dividend portfolio aims to be simple. So yeah, stick around and I'll walk you through the methodology, the numbers around this portfolio, and just to give you some idea of how I'm doing it, why I'm doing it, and more importantly, why the numbers stack up. Big disclaimer, I am not a financial advisor, I'm just doing this for experience, and as I say, a bit of a journal. And also, past performance will not indicate future results. A lot of this is based off numbers today. Those numbers may well change in 10 years, 5 years, whatever. So time to talk about the plan. And on the screen, there's some stuff, but we'll go through that in a second. But the first part of the plan is you've got an option of two things, really. For me, I'm using a stocks and shares ISA. This means zero tax on all of it. Great. But you can only put 20 grand a year in, which is where the limitation is. However, you've also got a pension, a SIP, as they call self-investment personal pension. Problem with that is, well, you could say it's a problem, but you get contributions from the government, but you also get taxed at the other end. So in my viewpoint, you're better off having the two. And I will talk about them in further videos down the line with what I'm doing with mine. However, this is designed to be my nest egg. When I'm 50 years old, I've got a pocket of money somewhere, which I don't have to pay tax on, and I can draw from at any point without any, penalties, so to speak. So that's kind of the point. And a lot of people have been saying, well, why are you doing it like this? Well, tax. And I'll come on to that in a bit. Now, I have, as it stands today's value, £54,000 invested. A little bit lower than that, actually, technically, because I have got profit in there. And I'm looking to add £20,000 every single year. That's the goal. That is the plan. And overall, you can see that if I plan to do that by the age I'm 50, you're going to start to see that this will start to rocket a little bit in value. Now, the numbers on the screen here is just based off today's numbers. So I said before, past performance isn't in, you know the point. But the reality is here, these numbers here is not including capital appreciation, which I will come on to in a second, right? Bear with me. So if I'm starting off with the 2.4 yield of dividends and there's an annual growth on average, right now my portfolio is 8%, which is pretty good, and reinvesting them dividends, that is the amount of dividends I'm going to get with the compound without capital appreciation on top. So basically, I'm going to get a nice little income at the end of that if it continues to remain at that point. And the yield on cost is then 7.6%, which I will talk about in more detail in a second, so don't get lost. That means even if the share prices don't move that much, this is still going to generate a decent amount of income by the age I'm 50 and also be £600,000 because 20,000 times 16 is a decent chunk, and then you got the dividends on top of it. That is the whole point of dividend growth investing. You get that snowball. And just to kind of demonstrate this is what I mean. So you're talking by year 6, you might be earning 5,000, then you've got year 8, and you can see it starts to compound because you are reinvesting those dividends back into those stocks. And also, if they are dividend growing stocks, you're going to start seeing a yield on cost growth. And I will explain that in more detail just to kind of give you an idea, because I think that's where people get tripped up with dividend growth investing, because they look at the yield and they go, oh, it's only like 1%, 2%, it's a bit low. But actually, if you look at what they're doing consistently over the course of time, they're going to grow. But this is also the capital appreciation of the portfolio, technically, without any capital appreciation. So this is kind of what it would be, as I mentioned before, with the dividends reinvested and also the amount of capital I'm putting in. But if we put the average 6% appreciation of the UK market, it's over 1 million, which is fine. But ultimately, that couldn't be anything it wants to be, realistically, long as the dividends are paying out. But I want to talk about this yield on cost. Basically, long story short, dividend yield is not the be all and end all, right? I always talk to people, certainly in my Discord and stuff, about dividends, and people go for the highest. You don't want to do that. You want to go for ones that are consistently rising, and I'll talk about the type of stocks that I'm looking for. But let me give you an example. Yield on cost is basically if you're buying a stock, right, and let's just say it's 2.4% dividend yield. And that is, say, 24p per share. Random numbers. But if that grows 8% per year, after 16 years, that will then become an 81p per share payout, right? That basically gives you an 8.1 yield on the original investment, so to speak. Even if you invested at whatever price, you are going to get paid more over time, dividends. And if you want to go down the rabbit hole, just Google Warren Buffett Coca-Cola, and he'll show you from when he bought in the 1970s and what he gets paid now in dividends is more than what he originally invested, which is mad. So it's one of those. So this is why dividends are pretty powerful, and it's a really good tool to have as a long-term investor, not a short-term, long-term. And it compounds over time and becomes a bit of an income in a way where anything can happen with it. So to give you a real-life example, this is BAE Systems in 2014, where if you bought it and put £10,000 in, dividend income over the course of that year, it's a decent chunk. But in the course of a 10-year period, it pretty much doubles, even just with reinvestment of the dividends, as the yield on cost does increase. And I'll showcase a chart in a second. But 114% increase in income from just reinvesting the dividends alone without adding further capital to that. And this is the yield on cost, which is in graphic form, obviously. 114% would be demonstrated over the course of time. That every single year, that small little growth of dividend is very, very important. Now, going back to the what if I want the 1 million sort of vibe, and I've already mentioned before, if we are going to talk about the zero appreciation, which it could happen, obviously you're going to get losses along the way, you know, over time, you're going to get a situation where actually, who knows, right? Now, 3.2 capital appreciation per year is what I would technically need to hit 1 million at 50 if I am doing the exact same situation of regular, contributions, the reinvestment of the dividends, the growth of it, and some modest capital gain here. But let's be honest here, that is almost half the amount of the average that we tend to get in the UK. So potentially, yes, it is possible. But if it doesn't happen, it doesn't happen. I will still, hopefully, fingers crossed, if I remain committed and consistent, and feel free to subscribe to follow the journey, I will have a decent nest egg to maybe retire on. But you're probably wondering, what type of stocks am I looking for and why is it UK based only? And it's intentional because of the US dividend stock withholding tax of 15%, which does chip away quite a lot and quite drastically at the compound effect. And 15% on all your payouts does add up. And there's a lot of good growth US stocks out there. There's some good compounding dividend stocks as well. But maybe I will do with different situations, but with withholding tax, it is only on the dividends. It is not on the capital appreciation, which is pretty good. But I just prefer UK stocks personally, as I've explained before. I'm in crypto. I want to keep it settled and simple. And this is kind of what I'm looking for. So consistent rise in dividends. I'm looking for a CAGR of basically 4% plus at least. I am looking for sustainable payout and lower dividend yield. What I mean by this in terms of lower is I'm not going for the craziness of something that's going 12, 13%, because often you find that the charts are looking the other way. You don't want that. Strong cash flow, obviously, because there needs to be a reason for the dividend payouts. I also want to kind of have a situation where the company alone is investing within themselves to make themselves better R&D and stuff like that. It's good for a healthy company to carry on growing. Durable competitive advantage is basically, well, is it a thing that's going to survive recessions, for example? Is it always going to be needed and required? I think that is quite important. Not to mention reasonable valuations, let's be honest. We don't want to buy something that's stupidly priced. And also, the main thing that people forget is companies that you use or are familiar with, right? You're never going to buy into a company that you've never ever heard of ever, or you have no idea what they are building, because if you're in the UK, you'll understand the economy, you'll understand the ecosystem and what they do. Like, I've got ones that are basically purposely built for steam power and wind power randomly, but you kind of know that because that is how, the backbone and the foundations of this country is built. And you could also argue what you like to do. If you like to shop at Tesco, why would you not want to buy the Tesco stock? If you are in the actual shop and you understand what's happening, that's probably a good thing. Same with Greg's if you like a sausage roll, for example. But also a mixture of long-term compounders and some growth ones in there, but not necessarily the be-all and end-all about growth. And as I said before, there will be further videos about growth because I'm in the blockchain space. I understand that there's blockchain funds out there that are very, very, very volatile that could do very, very well for your ISA, but they're a bit dicey and I don't really want to risk it all just on one of those. But yeah, let me know in the comments what sort of income are you aiming for in your own portfolio. And if this video has helped, let me know as well, because I do think you need to have a plan, and this is kind of my plan. This is my strategy, what I'm aiming to do. As I say, for some people it may be boring, but I have cryptocurrency that keeps me very much on fire most of the time, so that does help. But yeah, let me know what you think, and make sure you do subscribe, and I'll see you in the next video next week. Oh, before I go, watch this. This is what the stocks are, by the way, if you're wondering.